Today, I'm basically going to talk about, successful case studies both globally and in Africa where policies have basically driven investment into fintechs, and how this has driven financial capital, how this has driven returns on investment, and success. Right, so when we talk about financial inclusion, of course, we're talking about leveraging on innovation and technology, right, to provide access to financial products such as microfinance, micro savings, remittance products, and the likes, right? In addition to that, fintechs look at increasing financial service efficiency, decreasing operational expenses, and reaching individuals in rural and remote regions. And as such, fintechs have the potential to potentially significantly improve and promote financial inclusion. Now, these are a number of figures, right? So global VC funding by industry in 2022, fintech has consistently, both globally and in Africa, taken the majority of investments into tech startups, right? So fintech investments have climbed significantly from $9 billion in 2010 to $128 billion in 2021, with an increasing median round size, which has increased significantly. But in 2022, because of the financial recession and, of course, follow on from the effects of COVID and the likes, declined to $79 billion in 2022, right? So we can see from seed A to series A, B, and C, the increase in, so seed and series A globally has increased through the years, but then the later round of funding have decreased. Right, so in Africa, fintechs have raised between 2018 to 2022, depending on the report you read, there are different figures, but on average, fintechs have raised up to $4.45 billion across 603 deals, with fintechs in Nigeria raising the most at $2.8 billion, Kenya with $1.56 billion, and Egypt with $857 million. Now we ask ourselves, which is the purpose of why we're here today, when does policy meet capital, right? Now, fintech investments have increased in countries with better regulations. We've seen this even from the discussions we've had today, right? Countries that have actively implemented fintech policies or financial regulatory, built financial regulatory environments that are favorable to financial businesses, financial transactions, invested in payment infrastructure, have significantly seen a returns of investment, both on social investment as well as financial returns, right? And this has also driven the capital markets as well, whether we're talking about private investment from the early stage to later stage, to be attracted to those markets to invest in the fintechs as well, right? Now, one key move by the government, which of course we've heard today, is the implementation of sandboxes, the design and implementation of sandboxes, right? And what we've seen is that investment in fintechs respond to structural features of national economies, such as higher innovation capacity and better regulatory quality, right? Now, what do sandboxes do? They basically provide regulators and firms with a controlled testing environment for financial products using emerging technologies. They foster financial innovation and competition, but they also increase an appetite for risk, right? Because when we talk about new innovative solutions and products, one of the biggest concerns by both individuals, the individual innovators, but also investors, is dealing with risk. But with a controlled environment supported by the government, sandboxes de-risk fintechs, right? And they also improve information available to investors and reduce regulatory uncertainty. Again, this is about de-risking because they provide the sort of data to help investors drive, make informed financial decisions. And of course, they signal that authorities are inclined to support the entry of new players in the financial sector. So these are, a couple of case studies where sandboxes have basically driven innovation and increased the amount of fintech deals per capital. Now, finding the intersection between the inclusive approach to policy and financial inclusion objectives. I'll give a couple of case studies, starting with Singapore. So Singapore, despite its comparatively smaller domestic markets in relation to its neighboring countries, has established itself as a globally recognized fintech hub for investors and entrepreneurs, right? It's, according to Startup Journal report, it's recognized as #1 in Asia and #4 globally after Silicon Valley, New York City, and London, right? And there are over 1,000 operating fintech firms in Singapore now, representing 67% of fintech firms in Southeast Asia, which are numbered at 1,482. Now, why is this, and what are the policies and regulations that have driven Singapore to be #1 in Asia, #4 globally, right? So one is progressive regulatory environment. Of course, we've heard a lot about that today. The Monetary Authority of Singapore, MAS, which has fostered a supportive and inclusive forward-thinking regulatory and environment, as well as investment in infrastructure, investment in low-cost and zero-cost payment infrastructure and platforms, and also looking at the likes of digital payments, cryptocurrency, crowdfunding, and robo-advisory services. A regulatory sandbox as well, basically structured to give fintech companies the freedom to experiment and test new solutions. Talent attraction and development. We've heard this over and over and over today. It cannot be overemphasized. We cannot build a fintech ecosystem or any, industry without the right talent. Basically, investing in the right talent, investing in education from the ground up. Right, so, and also building an enabling environment for talent to work in as well and to move from other locations as well. So a trained workforce has been fostered by programs like financial industry competency standards, framework, educational initiatives, and the likes. And of course, Singapore has made it easier for financial technology companies to travel across borders, giving them access to consumers and partners across Southeast Asia. Again, we've discussed a lot about the harmonization of policies and the importance of making it easier for companies to scale across countries and access larger markets, which will drive, success of the business and also returns on investments. Now, again, these are some of the figures. In 2022, fintech investments in Singapore alone was up to $4.1 billion. 2021, $3.4 billion. So there's an increase despite, remember the earlier studies I showed you that, the numbers basically reduced globally in terms of fintech investment because of the economic recession and the likes. But in Singapore, it's actually the other way around, and there has been an increase, which is fantastic. And of course, the economic impact, economic and social impact, is nearly 1/4 of new jobs in the finance industry are created by fintechs. And of course, financial inclusion as well. An increase of largely the population getting access to financial services. Now, another global case study is Lithuania, which has positioned itself as an attractive entry point for fintechs in Europe, right? They're ranked number 10 in global fintech ranking, 9th in lowest risk, 9th in terms of the lowest risk jurisdictions globally. There are 256 operating fintech firms and 5,900 employed in the fintech sector. Now, what are some of the policies and regulations that have driven this? We have the Newcomer Program as an example, which is a one-stop shop consultation service for financial market participants interested in applying for a license in Lithuania. Now, one of the things that we've always seen in our line of work is the countries that make it the most easier for entrepreneurs to set up their business, understand where all the licenses can access the licenses, but also access information is quite important. So a one-stop shop set up by the government is always a driving force because one, it has the information and the data needed by entrepreneurs to set up. Of course, we've heard about how Rwanda, you can set up a business in 6 hours. Now, it is most effective because Rwanda actually has a one-stop shop as well, which is sat in one of the government agencies, and it's easier to find information and find all the data and licenses needed to set up your business. Because you could set up a business in 6 hours, but if you spend 3 weeks researching on all the different licenses, then it really doesn't count. So having a one portal for information is very important. Regulatory sandbox, of course, spoken about that in detail, and then talent development as well. So you see talent development is a common theme as well for a successful FinTech ecosystem. So private and government initiatives to develop a pool of FinTech talents, working with universities and partners like NASDAQ, Kaunas Technical Universities, and even programs run by the Ministry of Economy and Innovation, right? So now I would come to another global example. Here in Africa, M-Pesa, which I'm sure a lot of us are familiar with as one of our most successful FinTech case study. So M-Pesa is Africa's largest FinTech, launched in 2007 and caters to over 51 million customers monthly. And how it works is customers can basically utilize their mobile phones to conveniently perform various financial transactions, such as money transfers, payments, savings, and credit access. Now, it originated as a banking service through a partnership with Safaricom, the Kenyan telecommunications company, and the Commercial Bank of Africa. Right, and it's grown through different iterations of both regulations and its product, which I'll explain in the next slides. In terms of the investment and ROI, M-Pesa serves over 51 million clients and over 465,000 businesses. The service operates through 600,000 agents across multiple countries. Each of these agents are generating income, jobs are being created, and they're impacting their communities. And M-Pesa also processes more than 61 million transactions daily and contributes 41.5% of Safaricom's total revenue, right? In terms of financial inclusion impact, Kenya has emerged as a trailblazer for financial inclusion in sub-Saharan Africa due to the adoption of M-Pesa, right? And of course, financial inclusion among adults exceeded 85%, which is a significant rise from 26.7% a decade ago, and which is, of course, the highest on the continent. Now, again, what are the regulations that drove this adoption, right, and success of M-Pesa? Now, the Kenyan supervisory authorities employed a test and learn approach, right? So a lot of what we're taking here today is the willingness of the government to experiment, right, to test, to learn, to take risks, right, in a controlled environment, working with the innovators and the various stakeholders like the banks and other stakeholders. Now, this is basically broken down in different phases, right, called generations. So the first generation of the regulation and the development, and then, follows through, right? So, the first iteration, M-Pesa started as a person-to-person, P2P money transfer system that allows individuals to make payments and send remittances. And the regulation that basically drove this is, all the way back to 2003, the Central Bank of Kenya Act, which authorized the supervision of the national payment infrastructure. In 2006, there was a communication law which recognized electronic money, enabling telco companies to store value in SIM cards. And there was an establishment of a trust account by the Kenya Central Bank, governed by the trust law, which served as a foundation for M-Pesa transactions. Now, for the next, in the next phase, we had the Central Bank of Kenya again issued regulation that would allow M-Pesa to connect with individual savings accounts at commercial banks, right? And this basically led, Safaricom to collaborate with more commercial banks. I think in the earlier panel spoke a lot about collaboration and even FinTech working with the big banks as well. Safaricom, able to collaborate with more commercial banks to link their services with M-Pesa, leading to the introduction of savings accounts and attracting deposit interest rates. Now, the next phase, we had regulations that, the Central Bank of Kenya, working with the Communication Commissions of Kenya, implementing guidelines to mitigate financial risk, including measures to address liquidity risk, right? Liquidity risk, of course, always a concern for users of mobile money wallets, but also for investors as well. And these guidelines aim to ensure that the counterparty obligations were settled in full value and on time, minimizing the potential risk associated with liquidity. And because of this regulation, right, very deliberate, step by step as we see the progression, M-Pesa and other mobile money services, by the way, were used by banks and telcos to gather client transaction and savings data. And with the help of this information, financial intermediaries were better able to analyze client behavior and provide customized credit scores, right? So that's the example in terms of the sort of regulations that drove the success of M-Pesa. Now, another case study, I'll use Paystack, right? And explain how certain regulations in Nigeria, led to the success of Paystack, right? So Paystack is a Nigerian fintech company that allows businesses in Africa to accept payments from anywhere in the world via credit card, debit card, money transfer, and mobile phone, right? As a provider of payment services, they process millions of dollars of transactions each month for more than 60,000 SMEs and bigger firms, including FedEx, UPS, and MTN. Now, when it comes to financial inclusion, Paystack has done a really great job in even empowering small businesses in markets that they operate in, multiple African markets that they operate in, better manage their payment, better reach out to customers, better manage their finances and the likes, right? So investments and returns of investment, Paystack has raised over $10 million in 5 rounds since its launch in 2015. And then for the returns, for $200 million, Stripe purchased Paystack in 2020. Following the exit to Stripe, 40 corporate and 20 individual investors in Paystack made significant returns. And Y Combinator, which invested in Paystack with $125,000 for a 7% equity, got their returns of up to $14 million, just by investing $125,000, right? Now, what are the inclusive regulations in Nigeria that facilitated the success of Paystack and many other successful fintechs in Nigeria? The Central Bank of Nigeria implemented multiple guidelines from 2007 till now, introduced guidelines. In 2009, the Central Bank of Nigeria introduced guidelines for mobile money services in Nigeria to ensure and organize and structure development of such services. Additionally, we had other policies and regulations such as the electronic payment guidelines, which provided specific regulations for various e-payment channels, right? Such as automated teller machines, ATM, POS machines, and the likes. Now, these guidelines facilitated the growth of payment solutions. I'll come here, back to this. Now, based on the case studies, and also even a lot of the conversations we've had today, what are some of the recommendations for policymakers and for investors as well? Now, for policymakers, very important to develop policies that are flexible, right? Flexibility is very important because the nature of, the technology space, the sorts of innovations that come in, used to have a longer lag time of 10 years, 5 years, and now we have the likes of generative AI, which we spoke about earlier, and ChatGPT basically, almost overnight taking over. So it's very important for policymakers to be flexible, and that's where the sandbox model basically come in. Bringing all the stakeholders together to create an enabling environment for innovation and startup growth is quite important. So it's not just about the government, right? So we have the government, we have the investors, we have other regulatory agencies, we have the development agencies, and of course the academia as well, and the corporates, the big telcos and banks and other organizations. It's important to bring all the stakeholders together, creating an enabling legal and regulatory environment for market-driven development of innovative financial services like Sandbox, and then of course setting up creative financial instruments such as fund of funds, right? We're seeing that increasingly on the continent, with governments now beginning to see fintechs, but startups generally, tech startups as an asset class for the government. Of course, earlier speakers spoke about the Pension Act, for example. So the emergence of fund of funds will drive more investment into fintechs by also de-risking the investments that come from the private sector. So we've seen examples of this, like even in Rwanda here, where we have a Rwanda Innovation Fund, which matches private capital to invest in startups as well. There's a Tunisian fund of fund and other on the continent. Now, ensuring close cooperation between relevant regulatory agencies in order to develop a coherent supervisory framework and prevent regulatory arbitrage. Now, again, that's very important because we can have those, keep referring to the great panelists earlier today, is that you can have a fantastic regulation at the top level, right? But even if the remittance-focused regulations, for example, the tax regulations are not aligned, and all these smaller agencies, even at the grassroots level, are not aligned with the top policies, then it's basically not going to be successful. Creating enabling environment and incentives for M&As, but also building the capital markets is quite important. And African policymakers should look into harmonizing fintech policies to ensure the ease of scale for fintechs and also for the interoperability of financial transactions. Now, it's not enough for governments, of course, to just set the policies and right regulatory environments for one market, right? Because we need our startups to be successful and scale beyond, borders, right? And beyond multiple borders. So the harmonization of policies is quite important. Interoperability of policies as well, and the regulatory environment is really important. I'm really excited about Pan-African commitments, such as the African Continental Free Trade Area, for example, and even PAPS, right, the Pan-African Payment Settlement System. So these are, harmonized regulatory frameworks that I'm really optimistic about more governments not just signing and ratifying, because that has happened, but actually implementing and aligning all the relevant policy and regulatory agencies within each government to ensure that they successfully key into this Pan-African and harmonized policies as well. so that it's just easy. You know, if there's a fintech that starts up in Zimbabwe and they want to scale to Egypt, they want to scale to Kenya or Senegal, it's easy. They don't have to go through all the central bank licenses from start, do all the paperwork, set up, an example was given here about how, you literally have to pitch to your investors to hire a team of lawyers and accountants to just deal with the new market. So we need harmonized policies to reduce these barriers. And again, for me, it really isn't just about the capital and the returns, the startup scaling and making everyone money. It's also about the time to impact, because the faster that innovators can scale, then the faster it is that they can drive their policies to market and drive financial inclusion across the continent. And of course, leveraging on existing infrastructure. So I'll speak from a perspective of AfriLabs, the organization I head. AfriLabs is a network organization of innovation and technology hubs across Africa. So we operate across 52 African countries, 200 African cities, all incubators, accelerators, innovation hubs that are working to support tech entrepreneurs, innovators, and startups on the continent, including fintech. So what has happened successfully is we've also had governments, Rwanda, gave that example as well, working with incubators and accelerators to support these innovations. Now, I know my time is up, so I'll just leave it here. We developed policy pathways, which basically looks at 10 priority areas for governments to adopt to build a strong innovation and technology ecosystem. And this is a holistic view that covers, the importance of talent, so promoting digital skills for inclusion and employment, encouraging entrepreneurship and startups through legislation, so the likes of Startup Acts and other startup and innovation-driven policies, creating an enabling environment to attract investment. So what are the policies set in place to attract capital, right? And then adopting pro-innovation tax policies, enabling an inclusive digital payment ecosystem, spoke about that a lot today, and committing to harmonized policies, preserving digital rights and access to digital infrastructure. That was a constant recurring theme as well. Digital infrastructure is very important because you can have the technology and the innovations, but if there's no internet connectivity, for example, then the citizens cannot take advantage of it. Digital rights as well, an important point was made earlier about ensuring that as we prioritize digital ID, we ensure that it doesn't further drive social exclusion as well. So that's important. And of course, promoting innovative uses of data as well, building R&D capacity and protecting IP. A collaboration with universities isn't only about the talent, it's also about research and development. And one of the things we always advocate for is that we need to start ensuring that our universities and students focus on research that are tailored to identifying and solving real market and industry challenges. And these research are, developed into the sorts of innovations that would drive economic development and social growth. And of course, simplifying public procurement for innovation, because if you have a successful startup and yet they cannot access government, which in some countries make one of the highest employers or users or highest buyers of products and services, then they're not likely to be successful. So that's a very important point. Thank you so much.